Live from Brussels, this is Bloomberg Daybreak Europe. I'm Oliver Crook with your top stories. The blockade is back. Brent touching $85 a barrel for the first time in a month as the U.S. strikes Iran again. President Trump reinstates the blockade of the Strait of Hormuz, demanding a 20% transit fee. Fed in focus, energy shock fuels bets on a July rate hike as Governor Waller says rates may have to rise. Inflation data and testimony from Chairman Kevin Warsh later today. And 5 of the biggest banks on Wall Street kick off earnings season. We're expecting nearly $39 billion in trading revenue. Good morning. This morning, we're kicking it off with the equity markets here across the board and across the world. We are seeing some selling there in Asia Pacific going to unchanged territory, some more muted action in Asia than what we saw yesterday, but still there you can see it. Asia Pacific MSCI index basically unchanged for the day. Going into the European session there, so European stocks 50 futures down by 0.6%. And again, the S&P futures a little bit more muted than what we saw yesterday across the selling in America. S&P futures down basically 3 points this morning. When we take it cross asset, we see much more of the action will be focused on across the day. Brent oil in full focus there. You'll remember at around this time yesterday, we were trading still below $80 a barrel. We are now trading close to $85 a barrel for Brent crude, up about 2% this session. The U.S. dollar index down by 0.1%, and U.S. yields full focus. As we hear from Kevin Warsh a little later today, we get that inflation data and, of course, a radical sort of repricing of Fed expectations after the restart of the war in Iran. We're also watching a number of different risk events throughout the day. We'll be listening to the Governor of the Bank of England, Andrew Bailey, speaking before UK Parliament at 9:45 UK time. That US CPI data, all important, at 1:30 p.m. UK time. And of course, 3 p.m. Kevin Warsh speaking before the House testimony. Of course, the main risk event of the day, if you're French or Spanish, the semifinal of the World Cup.
We're attacking them tonight. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing.
There, the President of the United States speaking from the Oval Office, vowing U.S. control of the Strait of Hormuz. The U.S. President has reinstated the blockade of Iranian ships and demanded a 20%, quote, reimbursement for all other cargo that is shipped through the strait. There's a lot to unpack. We have team coverage for you this morning. For the latest on the ground, Horizon's Middle East anchor Abir Abu Omar for the impact across the oil markets, Wrong Way Neo, and the downstream read-through, inflation from our MLive strategist, David Savage. Abir, let's kick it off with you. We know there have been strikes overnight. What has Iran's response been? Where do we sort of find this story this morning?
Good morning, Ollie. A sense of deja vu, really. I don't know what to say that's different from yesterday, for example, when we reported those tit-for-tat strikes continuing to happen into the early hours of our time in the Middle East here, where the U.S. started by hitting targets in Iran, citing that a lot of those were military targets. Iran hitting back countries in the region, namely Kuwait, Qatar. Yesterday, or into the early hours of the morning here in Dubai, we saw attacks happening again. Iran hitting countries in the region yet again. That includes Jordan. Oman had also suffered some attacks by Iran. And then at the whole, with this whole thing happening, the Strait of Hormuz really comes back into focus this time around, Ollie, with President Trump overnight saying that he will issue this 20% fee on ships. And I know my energy colleagues are on this panel. They'll talk a little bit more in detail about that later. But that equates to about $30 million for a single ship, according to our reporting, or a little bit more than $30 million with current crude prices at $85 on the barrel. So we're seeing these new elements come to the Strait of Hormuz. Iran saying through the foreign minister that it will continue to be the guardian over the Strait of Hormuz and that it will forever be the guardian over the Strait of Hormuz. And just before we started speaking, just moments ago, we heard from the Iranian parliament on a post on X saying that there is this strategic action for the security and sustainable progress of the Strait of Hormuz, that this new bill was approved by the parliament. We don't have much clarity on what that means or what it will ensue, but it essentially suggests that it would legislate a framework for ships in the Strait of Hormuz, including fees. And so now we're seeing both sides of the table, both Iran and the United States, saying that they will issue fees, and then ship owners are still trying to decide what to do with that. And traffic in the Strait of Hormuz since yesterday has been nearly at a standstill.
Yeah, Abir, it's sort of remarkable. The only thing that there seems to be consensus from on the Iranian and the U.S. side, at least in the last 24 hours, is that there's going to be some kind of toll or fee. The question is who is going to charge it. The difference is the Iranians don't need to have full control. They can just disrupt it in order to basically say they have control of the strait. In order for the United States to charge a protection fee, they need to have total control of the strait. Is total control of the strait a realistic ambition for the United States?
That is a really good question, Oli, and it's still unclear whether that could be the case for the United States. For the time being, President Trump did say that he will have a blockade on Iranian ports. Now, that's proven to be slightly successful in the past, but then bear in mind that in the past, Iran was not able to send out its crude shipments. That was part of the clause that we had talked about when it comes to the 14 concession MOU, where Iran was able to sell its oil, but then that was revoked by the Treasury when Iran started hitting ships. But then what Iran has been doing in the Strait of Hormuz is, as you have mentioned, disrupting the traffic. And it doesn't have to be big hits for ship owners to decide to just hold still for the time being until more clarity over the situation ensues. Yesterday, we heard from the UAE's defense ministry saying that Iran hit 2 ships, killing 1 person and injuring several others. And so if these attacks continue to happen, that's alone for ships to decide that maybe it's time to take different routes or to turn off their transponders, as they have been doing over the past couple of months or so. So how realistic, your question about how realistic is it for the United States to take control? A lot of unclarity about the situation still. For the time being, we're talking to ship owners. Our teams are talking to those ships trying to make their way through the Strait of Hormuz. And it does look like yet another layer of complication from the Middle East this morning. And this is what you're seeing reflecting in Brent crude prices at almost $85 on the barrel, the first time in about a month.
Well, Abir Abu Omar, keeping us abreast of all the layers of complexity. Thank you, as ever, this morning. Brent futures have spiked above $85 a barrel for the first time in a month. Let's bring in our Bloomberg Asia oil trading reporter, Wrong Way, now. I'd like to just break this down for you. There's 2 segments of this now that the President of the United States has sort of introduced to the gas and the oil market. There is first the blockade. There is second this idea of the fee. How are the 2 sides, how are oil and gas sort of traders and, of course, the sort of cargo companies sort of viewing both of these things?
Right, so if you look at the latest developments from Trump's proclamation that it would essentially set up a blockade on Iranian ships coming out from the Gulf, we have seen this happen before, of course, and of course in the interim period, Iran has successfully still managed to bring out vessels carrying Iranian crude out into the market. But do note that in terms of this Iranian oil trade, it maintains, the dynamics maintains that pretty much China is the major buyer that has continued to purchase Iranian oil. But the latest, as it stands, Chinese demand has been really low lately. If you look at the latest data in June, China's crude imports fell to its lowest in nearly a decade. So in terms of supply risks, there doesn't seem to be much action going on in terms of how the blockade could actually impact Iranian volumes being brought out to the market, because essentially apart from China, no one else is really purchasing these barrels. And if you recall, when the US sort of set up this waiver to allow other mainstream crude buyers to purchase these barrels, a lot of them had held back because they fear secondary sanctions as well as other repercussions that may arise from buying these barrels during the short waiver period. But of course, like Ollie, like you mentioned, the more pertinent point that the market is looking at is the 20% fees that we have spoken quite widely earlier. Now, of course, a lot of shippers agree that these added costs will be passed down to the consumers, which of course raise price premiums for major crude importers, especially here in Asia. And the timing of the announcement and the lack of details on how it's going to be implemented has sort of left Asian traders blindsided. In fact, I think one of the more memorable conversations I had with traders here this Asia morning was one Singapore-based trader essentially quipped. He was questioning how did the US arrive on this arbitrary 20% number, and he even joked that it felt like Trump was bringing US's its tipping culture all the way to the Straits. So it remains to be seen actually how these fees would actually be imposed and how much of it would actually impact actual shipping. But I think, Ollie, like you rightfully mentioned, what we can agree and what the market agrees as well is that following this war, it seems like some form of fee payment structure would remain. Earlier this month, we actually had a report. We do believe that some of the leading European powers have sort of considered that payments for transits through the Strait of Hormuz is inevitable. And now I think the overnight developments essentially seals the deal. And all eyes are on how all these would actually pay out.
Yeah, wrong way now. Thank you so much for that. Yeah, I think the Europeans were expecting to pay a fee. I don't know that they were expecting it to pay to the United States. And as the price of oil rises, so too do bets for a July interest rate hike from the Federal Reserve. Traders now await upcoming U.S. inflation data and Fed Chairman Kevin Warsh's appearance a little bit later today. We heard from another Fed Governor, Chris Waller, signaling that further rate hikes may be warranted should underlying inflation continue to reflect broad-based price pressure.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. As always, we need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation.
So some strong words there from Chris Waller. Let's bring in David Savage, Bloomberg's MLive strategist. You know, this is a real sort of paradigm shift in terms of what the expectations of the Fed were really expectations that things were going to remain sort of nothing really to see here this year. That is now changing pretty dramatically.
Yeah, absolutely. And so, you know, we look at that pricing for July hike. It's now basically a coin flip. So last week, that was more like 20 to 30% odds. The jump in oil prices, and then, of course, Governor Waller's comments there, have put July's meeting in play. And certainly that's of interest to traders ahead of U.S. CPI and Warsh's testimony today. And I think those 50-50 odds, make some sense, given that, much of the disinflation narrative that, traders on the sides that we should be moving away from rate cuts was really built around headline CPI coming down because oil prices were coming down, and energy inflation wasn't going to seep into core inflation, and that narrative changes if we continue to see oil prices move higher. So a Fed that had already been posturing more hawkish is now looking at a very different oil price backdrop.
And what obviously we're watching the CPI data very closely a little bit later today. We're listening to Kevin Warsh. You made the point yesterday that basically if you get a sort of hot print on CPI today, that might lock in expectations. What are you watching for?
Yeah, I think the way pricing has moved now, it's a bit more of a fair fight. I think the problem coming into this was, the expectations for headline CPI was for it to fall 0.1% month over month, headline CPI to come back down under 4%. And now, of course, if you get that reading and you get not much in terms of commentary from Fed Chairman Warsh, then things kind of continue, and we see where oil prices move to start to figure out whether the pricing on a July hike makes sense. Of course, again, I think the asymmetry came in that if you had a surprise to the upside on CPI, that would really start to ratchet up the bets for a rate hike nearer to today than waiting till later in the year. So I think that was the asymmetry, and I think that's why the 50-50 pricing makes a lot more sense now.
Well, David Savage, Bloomberg's MLive strategist, had a fairer fight for the Federal Reserve, looking at that this week and the pricing across that for the rest of the year. And we'll have full coverage of Kevin Warsh's testimony at the House Financial Services Company. That will be at 3 p.m. London time. But still ahead this hour on the show, Wall Street's trading bonanza is poised to keep rolling. The biggest U.S. banks are set to kick off earnings season with results later today. We'll have your preview. That'll be next. But first, President Trump backs a sweeping Russia sanctions bill championed by the late Senator Lindsey Graham. More on how it could tilt the scales of the war next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Bloomberg understands that President Trump plans to support a Russia sanctions bill championed by the late Senator Lindsey Graham. We've been hearing about this bill for quite some time, and it seems that now it has gained the president's interest and support. The proposed bill would intensify pressure on the Kremlin to end its war in Ukraine, bolstering efforts to punish buyers of Russian oil and gas. For more on this, let's bring in Bloomberg's Russia EcoGov team leader, Tony Halpin. Tony, thanks so much for joining us this morning. What do we know about the form of this bill as it now enters and crosses potentially the president's desk, and how much support there is on this bill from the president of the United States?
Yes, I mean, the White House is signaling that Trump's inclined to support this bill. Trump himself has been a little bit more ambivalent about it. But that's one of the key issues now, Oliver, as the legislation approaches the White House, what exactly the terms of this legislation are. We don't know, for example, if the previous weapon in that legislation, which Lindsey Graham, the late Lindsey Graham, said amounted to bone-crushing sanctions, something like 500% secondary tariffs on buyers of Russian oil and gas. We don't know if that has survived into this current legislation. Clearly, if it has, that would be an important signal to Moscow that Trump is beginning to harden his position in relation to Russia. But also, I think this legislation simply empowers the president to impose these sanctions. Previously, Trump has pushed back because they said that a measure like this would interfere with efforts to negotiate a diplomatic solution to the war. But if now he has that weapon in his arsenal, it would be an indicator, I think, that perhaps the White House is focusing again on sanctions and again on efforts to push Russia towards more of a compromise to find some way to bring this war to an end.
Yeah, and it's probably dependent on this idea that President Trump, of course, 18 months ago was telling Zelensky he's got no cards, but a sense that Zelensky now does have some cards, has some cards on the battlefield, has some cards in terms of financing, has a number of other cards, while at the same time there's a sense of domestic pressure on the president of the Russian Federation, Vladimir Putin. What do we know about the pressures that Putin is under at this time?
Yes, I think you're right. I mean, the symbolism of this is important. It follows the meeting between Zelensky and Trump at NATO, which went very well by all accounts. And at home, Putin has increasing numbers of problems. The war is more and more visible to ordinary Russians. Ukrainian strikes on oil refineries have led to widespread fuel shortages. Russians are now lining up, often for hours at a day, to simply get fuel for their cars. And that's making many of them, of course, very discontented and beginning to ask questions about why this is happening to them. And on top of that, you've got issues like more and more visible strikes on Russian cities. More and more Russians are seeing that the war is coming closer to home.
Well, Bloomberg's Tony Halpin, thank you so much for that important context, both within Russia and, of course, the broader sanctions we may be seeing from the United States. And coming up next, the result from the latest Bloomberg Markets Live Pulse survey are in. Find out who investors want to see as the next UK Chancellor, and critically, who they don't want to see as the next UK Chancellor. That's next, and this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Andy Burnham, the UK's presumptive next Prime Minister, is yet to name his Chancellor. But among the potential candidates, the Energy Secretary Ed Miliband is seen as the least market-friendly choice. That's according to the latest Bloomberg Markets Live Pulse survey. Let's get more from with Morwenna Iconium, the co-editor of Bloomberg Markets Today. So we know who the least sort of friendly to the market is going to be. Who would be the most friendly?
The most friendly is expected to be Wes Streeting with over 30% of votes in our survey. I think that's not a huge surprise. He is known to be a lot more centrist in his views. Ed Miliband is sort of associated with higher spending plans and potentially therefore higher taxes. But the market is very much saying Ed Miliband first and then, Ed Miliband last, but Wes Streeting, coming out on top by quite a wide margin over the other candidates who we, put forward as likely options. Darren Jones, coming in quite weak as well. John Healey, the former Defence Secretary, coming in quite a way behind, but the next best considered after Wes Streeting. But lots of people actually chose someone else and put in a suggestion of their choice as well, but that was 16% of votes. So there's certainly a lot of variety in people's thoughts, and I don't think there's a certainty there at all.
And more broadly, how is the market and how are sort of the market viewing the effect of a Burnham in sort of 10 Downing Street on broader UK assets?
Yeah, so overall, market participants do expect Burnham's premiership to have a potentially negative impact on UK assets. About 40% of the respondents said that it would make them more bearish on UK assets. And about another third were already bearish, and they said it wouldn't make any difference to their opinion. That was a lot more than those who said it would make them more bullish. And I think when we look at the individual assets, they do see gilt yields rising slightly to an average of 10-year gilt yields about 5%. And they see, the pound on average coming back to about $1.30. But there was quite a wide range of variety in the responses. And these aren't, huge moves. I think what really is the strongest takeaways from this survey is that overall a bearish attitude to assets, and the fact that there are quite strong opinions on who would make the best Chancellor. And I think a lot is riding on that because there is a lot unknown actually at the moment about Burnham's economic policies and what he'll do. So I think really markets are waiting to find out who the Chancellor will be. Particularly, we've actually seen quite a steady period for gilts through all this until now.
Yeah, and very quickly, you've also put a question about expanding potentially the BOE's remit to beyond inflation and price stability, but also to growth. What did you learn from that?
Yes, so actually the suggestion that has come from Burnham's camp about expanding the Bank of England's remit to include growth as well as inflation, while the idea of sort of higher growth policies that might come from Miliband weren't very popular, this particular policy did seem to strike a chord with market participants, and they were broadly in favour of that, which I think is quite important, particularly as we look forward to the central bank and what they're going to do the rest of this year. The market has been quite fluid on that, and the moment still pricing in one interest rate hike by the end of the year. But the situation is fluid, and perhaps we a lot of market participants expect them to keep rates on hold. So I think it will be quite interesting to see what they do. And of course, if their remit was to change, then that would make their job potentially more challenging, but also potentially easier, depending on what their focus is. They've talked a lot about growth recently.
Yeah. Of course, it's a debate that we're hearing a little bit more in other central banks and other nations as well. Morwenna Iconium, thank you so much, co-editor of Bloomberg Markets Today. Coming up, no fewer than 5 of the biggest banks in Wall Street kick off earnings season today. We'll tell you what to expect with your preview. That's next. And this is Bloomberg. Live from Brussels, this is Bloomberg Daybreak Europe. I'm Oliver Crook with your top stories. The blockade is back. Brent touching $85 a barrel for the first time in a month as the U.S. strikes Iran yet again. President Trump reinstates the blockade of the Strait of Hormuz, demanding a 20% transit fee. And the Fed in focus. The energy shock fuels bets on a July rate hike as Governor Waller says rates may have to rise. Inflation data and testimony from Chairman Kevin Warsh later today. And 5 of the biggest banks on Wall Street kick off earnings season today. We're expecting nearly $39 billion in trading revenue. Good morning as we enter the session this Tuesday, looking at the markets across the board here, seeing a more muted reaction across equity markets. There you can see it in Asia Pacific, really turning things around over the last couple of minutes. In the last 30 minutes, we were dead flat really about 30 minutes ago. We're now up by 0.5%. Euro Stoxx 50 futures, though, remain in the red. They're down by 1/3%. And there you see a little bit of gain there from the S&P futures. We're down very, very slightly at the top of the show here. And you see 30 minutes later gaining ever so slightly by about 1/8%. Going on to the next board and cross asset, what we're watching, of course, Brent crude in full focus here with the renewed blockade of the Strait of Hormuz by the President of the United States. Brent crude up there almost at $85 a barrel, up by 1.44%. The U.S. dollar index down by, again, about 1/8% there. And then yields in focus here across the curve, across the world. U.S. 2-year yields down there ever so slightly. You get about a 4.2795% yield on that U.S. 2 years. Time now for your front page news across the world, starting with the Financial Times with reports on the latest strikes between the United States and Iran, and the President Trump demanding a 20% fee on cargoes passing through the Strait of Hormuz. And the Wall Street Journal saying that a wave of Iranian nationalism is drowning out its diplomats. It's adding to that fervor whipped up during the conflict that is making it harder to compromise and easier for hardliners to stymie progress on negotiations. And Germany's Handelsblatt says shipping companies are ordering more oil tankers than ever before as a result of the increased charter rates resulting from the Hormuz blockade. And you can get a roundup of all of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. Well, the 5 major banks on Wall Street are reporting a little bit later today. They're kicking off earnings season for us all. A global surge in deals and IPOs is expected to drive blockbuster results as volatility from the ongoing U.S.-Iran conflict fuels equity trading revenues. For more on what to expect on an important day for bank earnings, we're joined by Bloomberg's editor, Balazs Pence. So listen, we've been talking about trading revenue, not just in this quarter, not just in the last, but for a number of quarters. How long will this party continue, and will it continue into this quarter as well?
Well, as long as we have days like today, Ollie, like the headlines that you just read through, that's a great example of what's been driving that record revenue in the first quarter and what's likely to drive very close to that, something very close to that in the second quarter. We had these whipsawing headlines coming from the Middle East every single day, driving up volatility. We had the ebb and flow of sentiment around the AI trade, also increasing volatility, particularly here in Asia. So banks that were more exposed to the Asian trade, like Morgan Stanley, are probably coming out for the better for that, because volatility is a great time to make money on the markets, and that's animated a lot of investors. Trading activity has been through the roof and has been very strong for a few quarters now, and that's what we're going to see when those 5 Wall Street banks report earnings in the single day. So spare a thought for the bank analysts having to digest all that as well.
Yeah, and we'll also spare a thought for some of those who have been waiting for the revival of M&A and, of course, the IPO market. And that is something that we've seen come back with some very blockbuster names listing. What are we expecting in the sort of deals front?
That's right, and it doesn't come more blockbuster than SpaceX, which was the biggest ever IPO, which happened in this quarter. And we've seen a lot of companies along the AI supply chain coming to the market because they need to raise money, they need to increase production, they need to supply their customers, and this voracious appetite for all along the supply chain needed for the AI build out. So we've seen a lot of deals, not just IPOs, we've seen other types of deals, whether it comes to convertible bonds or whether it came to block trade, secondary share sales. A lot of companies have been in the market, both in the US and here in Asia as well. We've seen a wave of Chinese AI-related companies come to the market in various ways. And that's something that we expect to continue. We're just preparing for a big big chipmaker IPO here in China. There are obviously big US AI names expected to come to the market as well. So IPO M&A activity has been very, very strong. And that's also something that feeds into the volatility, that feeds into trading enthusiasm, and feeds into revenue for these Wall Street banks.
Well, Bloomberg's Balazs Pence, thanks so much for that preview today, and I'm sure we'll potentially be speaking to you tomorrow to get your sort of dissection of what we get out of the United States. Thanks again. And we'll be speaking with the CFO of Wells Fargo, Mike Santomassimo. That'll be at 8 p.m. London time, and we'll take it from the banking sector over to the telecom sector that we're watching this morning here out of Sweden. The Swedish telecoms company Ericsson's second quarter earnings have fallen in line with analyst forecasts as it faces rising component costs. The outgoing CEO says that the results underscored, quote, disciplined execution. We're joined now by Bloomberg digital infrastructure reporter Paula Döneke. So talk us through this report a little bit. What did we get? Is this sort of in line with analyst expectations? Were there any surprises here?
Good morning. Yes, it's a slight beat actually, but broadly in line with expectations. And that is good news for investors already because it was a tough quarter for Ericsson. We had 6.9 billion in adjusted EBITDA, that is Swedish krona, and that will be good news.
And thinking about where the company has faced pressure this quarter, where have been the sort of pain points for Ericsson?
So it's always costs, and Ericsson has been trying to cut costs for a while now. This quarter, especially, they are still seeing impacts from the Middle East, but these are subsiding. The more important topic now is the component costs that comes through chips, but also other components which are in short supply due to the build out of digital AI infrastructure in other parts. So obviously this is something that Ericsson hopes to profit from further down the line as they are building out these networks, but it's also something that now adds pressure on their cost base.
Yeah, absolutely. I mean, I think it's sort of interesting to watch Ericsson because you have this sort of dynamic in Europe where you have this great need for telecommunications, the build out, as you say, there of the digital infrastructure, while at the same time, European governments basically blackballing and cutting out, Chinese companies like Huawei. This really should be sort of a tailwind for Ericsson. What can we look forward to Ericsson over the next couple of months?
Yes, I mean, exactly. This discussion about blocking out Huawei will be very closely watched by Ericsson. It's a huge opportunity for them to replace those ports in European networks. Another thing that will be very interesting, the current CEO, Börje Ekholm, will be leaving the company after almost a decade in the top job. And Per Narvinger will take over. He's currently the head of networks. And for now, he's been with the company for a long time, so maybe he'll continue, but it might also be that he changes the strategy. That's definitely something I'll be watching closely.
Well, thank you very much. We'll also be watching very closely Bloomberg's Paula Döneke with the latest there from Ericsson, the Swedish telecoms giant. Now let's get to some other corporate news that we're watching this morning. Shares in Watches of Switzerland jumped after a report said that Britain's largest Rolex reseller held talks in recent months over offers to take it private. A report from Reuters said CEO Brian Duffy engaged with unnamed suitors, but the company is seeking an offer of more than £7.50 per share. The company declined to comment when approached by Bloomberg and is set to report earnings at 7 a.m. UK time. And Bloomberg has learned that Shein is targeting a Hong Kong listing as soon as August after securing long-awaited approval from China's securities regulator. Sources tell us that fast fashion retailer could raise between $2 and $3 billion in the IPO, marking its latest attempt to go public after failed listing efforts in the United States and in London. The offering comes as Shein faces pressure from slowing business growth amid rising competition. And a group of U.S. states has sued to block Paramount Skydance's $110 billion acquisition of Warner Brothers Discovery. That's despite a deal that's already secured approval from the Department of Justice. Opponents argue that a merger would reduce competition in Hollywood by combining major film studios and streaming platforms. And Bloomberg has also learned that Saudi Arabia's new startup carrier is set to lock in an additional aircraft orders from both Airbus and Boeing. Riyadh Air is firming up options for about half a dozen wide-body Airbus A350-1000 jets, along with about 30 Boeing aircraft. The state-owned carrier plans to announce the deal at the Farnborough International Air Show outside of London next week. Well, coming up, SK Hynix rebounds after a record fall on Monday. More on that story next. And this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Shares in SK Hynix rebounding after a record 15% tumble yesterday. It's very sort of difficult whether we should take a sort of bullish or bearish approach. So hopefully we can get a little bit of insight on that from Lianting Tu, Bloomberg's managing editor for Asia Equities. We've had a lot of volatility from SK Hynix over the last couple of days. Where do we find that volatility today?
Yeah, it's really up and down and all over the place. I think a lot of traders are talking about how, you know, the dual listing right now is giving them a bit of a heart attack 24 hours a day. So for today, I think two layers of sources for volatility. One is memory sector itself. Stocks in memory sector have run up so much. Now people are assessing whether the earnings for the sector is near a peak. So every data point is really getting scrutinized pretty hard by the investment community. That's why we're seeing, you know, every little data point is having such a big impact on these memory stock names. And second is market structure. In Korea, these two stocks, I mean, SK Hynix and Samsung, they account for more than half of the market weighting. So if one stock moves, it tends to pull the whole market along with it. And also on top of that, lots of leveraged ETFs are built on SK Hynix and Samsung, and they tend to have to mechanically rebalance. So they need to buy on the days when shares are up, they need to sell on days when shares are down. So that really amplifies the daily swings for both SK Hynix and Samsung, for that matter, Kospi as well. And if you look at a batch of leveraged ETFs around those stocks launched in late May in Korea, they are nearly 50% down from their listing prices. So a lot of retail investors who are the main buyers of such products are holding losses.
Right, and when you think about now that dual listing, as you allude to there, that there might be sort of, you know, a heart attack for the traders that now have to watch this 24/7, maybe in the short term providing some volatility as the sort of respective pricing gets there, but could it also have the potential of sort of smoothing out the trading as you can take kind of pressure out over that 24-hour period?
I mean, right now it seems that the feedback loop is being reinforced through that dual listing, because before, essentially, SK Hynix is a sole story. Wall Street would react to that, sometimes directly or through the likes of chip names such as Micron or NVIDIA. But right now, you know, the overall Wall Street trading would set the tone for sole trading. And because of all these leveraged ETFs and margin loans, that tends to amplify all the moves in Seoul. And that then gets fed back to Wall Street. So right now we are really seeing some kind of unhealthy feedback loop going on right now. And Korea, because of its position in the AI hardware supply chain, it's very much critical to that supply chain right now. Wall Street is really reacting to all the Korea volatility. And because Korea has a bunch of, you know, concentration issue and leveraged ETF issue, that kind of volatility right now really gets amplified globally.
Well, Lianting Tu, thank you so much there. Bloomberg's managing editor for Asia Equities, keeping us across all that important volatility over in Korea. Now to some other top stories that we're following this morning. Japan's finance minister has floated the idea of adding government bonds to a tax-free investment program as the government steps up efforts to attract cash to domestic markets as the yen trades near a 40-year low. Satsuki Katayama said the yen-denominated assets would become more attractive if the administration advances its growth strategy, and the nation's massive pension fund could revise its portfolio if needed. And China's exports and imports beat all forecasts in the month of June as the AI boom lifted demand for chips and data center hardware across Asia. Exports rose 27% from a year earlier, while imports surged 36%, the fastest pace in 5 years. That left a trade surplus of more than $125 billion, the second biggest ever. China's crude imports, meanwhile, plunged 41% to the lowest level in almost a decade as Beijing cut foreign purchases after the war in Iran began. Well, coming up next, we'll take it back to the politics. Hungary's parliament votes to remove the country's Orban-era president. More on that move next, and this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Well, Hungarian lawmakers have approved a constitutional amendment to remove President Tamás Sulyok, an ally of the former Prime Minister Viktor Orban. The legislation passed with two-thirds majority held by Prime Minister Péter Magyar's TISA party in Parliament. Magyar spoke following the vote about the president's political fate.
The president now has two options. Either he resigns now, in which case the Speaker of the Parliament will temporarily take his place, and then she will sign the bill, and after that, the law will be promulgated. Or he signs this constitutional amendment by himself. We have just fulfilled the will of our voters.
For more, we're very joined by Zoltán Szémen, Bloomberg's Eastern Europe editor. So listen, we've been talking now, it's been sort of a while since Magyar has taken office. There's been this sort of great sense of trying to the de-Orbanification of Hungary. How significant is this step in that process?
Yes, hi Oliver. It's definitely significant. It's probably the most significant step since April's landslide election victory for Péter Magyar. Although the Hungarian president is largely a ceremonial office, clearly for Magyar, he is a symbol of the Orban regime, a vestige, if you will. So he says, even though he would be unlikely to block any serious change in terms of government policy, he says Sulyok needs to be removed because he was fully aligned with Viktor Orban ever since he took office.
And thinking about the sort of broader project for Péter Magyar, obviously there was a huge amount of optimism for those who are sort of anti-Orban and pro-Magyar after his election, obviously with that two-thirds majority. But for those of us who have sort of lost sight of it since he was elected, how is that process going? And is there still that faith that Péter Magyar can bring all of those changes to bear?
Yeah, I think that's a really important point to make because let's remember a little more than 3 months ago, Orban's regime seemed invincible, both from inside Hungary and probably from outside Hungary. I mean, President Trump has, he repeatedly hailed Orban as sort of the symbol of a strong leader. Now he's watching the World Cup. He's nowhere to be seen as Péter Magyar is taking a sledgehammer to sort of his political heritage. And he's moving at warp speed, really unfreezing European funds, tackling corruption, as he says, trying to rebuild the rule of law, and also to claw back, potentially billions of euros in plundered state assets.
Yeah, and let's also think about Hungary and its sort of position in geopolitics on the wider stage, obviously within Europe and within the world, because obviously it's a relatively small nation, but has been the single blocker of a huge amount of EU action, obviously falling now more in line with the EU. And so basically give us some context around that, but also how close Hungary is to actually getting those frozen funds from the European Union.
Yeah, let's start with the latter. I mean, it is close. It's essentially, it has access now to those funds. It's now really sort of getting the projects for which it can actually tap the money. And, they are under that high deadline, especially the post-pandemic European Union funds expire at the end of August. But now it seems that they have the projects lined up for it. They have the political green light from the European Union and the member states. So really now it's just up to the government to move and to tap those funds. So I think investors also realize that money is likely going to come, if not in full, but most of them will arrive. And geopolitically, obviously, as you mentioned, Magyar's message was that Hungary is coming back to Europe. It's going to rejoin the European mainstream. It's going to be, as he says, a constructive voice in the room, both in the European Union and in NATO. Now, that doesn't mean that it's going to say yes to everything. You can tell that Magyar likes to drive a hard bargain. As he says, he's defending Hungary's interests, just like other leaders are defending their own.
Right. Well, Bloomberg, Zoltan, Simon, thank you so much for your time there from Budapest on the latest from Péter Magyar, the Prime Minister of Hungary. Let's get to some of the charts that we're watching a little bit later today. Ahead of that all-important U.S. CPI rating we're getting a little bit later. We're going to hear from Chairman Warsh a little bit later. But we've been watching a big repricing in terms of the market action and where they expect rates in the United States to go. We are now potentially going to get a rate hike this very month. That's a very radical repricing from what we've seen over the last even couple of days, and you can see it there, the sort of spread between the 2-year yield versus the Fed rate now reaching the sort of highest level that we've had in a number of years, in almost 4 years. We're also looking at crude imports out of China. This is another story that we're watching really closely. Didn't get a lot of airtime, but this is the sort of impact of the war in Iran and the impact that it's having on Chinese crude imports. Crude imports plunged 41% in terms of their imports from a year ago. That is the biggest plunge on record, and they purchased the smallest volume in China in almost a decade from outside of the country. And of course, the final thing we're watching for the sort of main risk events for those of you who are engaged on the World Cup, who might be Spanish, who might be French. And today, obviously, on the French National Day, Bastille Day, we have France versus Spain. That'll be at 9 p.m. on the continent. You go to the poly market odds in terms of what they're expecting after 90 minutes of play. 41% chance of a France victory, a 30% chance of a Spanish victory, and of course, a 30% chance of a draw after 90 minutes of play. I'm sure that will be watched very closely by you all across the world. And of course, the other risk events we're watching this morning, the UK Governor of the Bank of England speaking before Parliament at 9:45 today. At 1:30, we get that all-important US CPI data we've been talking about. And of course, we'll be hearing from Kevin Warsh before the House Banking Committee a little bit later today. That'll be at 3 p.m. UK time, 4 p.m. on the continent here. And later this morning, we'll get a check-in on the deals outlook with Jim Zentler. He is the president of Apollo Global Management. That's an exclusive conversation on the opening trade at 8:30 UK time. That'll be at 9:30 for those of you here on the continent. The opening trade is up next, and this is Bloomberg.